This is the story of a tax change that could save California seniors thousands of dollars in federal taxes, and how the SALT deduction cap increase signed into law on July 4, 2025, affects retirement planning for those living in one of the highest tax states in America. If you're paying significant property taxes or state income taxes on your retirement income, the increase from $10,000 to $40,000 might be the most important tax development of the year for your household. What happened and why it matters comes down to one piece of legislation. President Trump signed what's been called the One Big Beautiful Bill into law on July 4, 2025, and buried inside this massive tax package was a provision that quadrupled the SALT deduction cap for most taxpayers. The cap jumped from $10,000 to $40,000, but only for people earning under $500,000 a year, and the increase lasts through 2029. SALT stands for State and Local Tax Deduction, which means you can deduct the state and local taxes you've paid from your federal taxable income when you file your return. Your California state income taxes count, your property taxes count, and in some cases sales taxes count too. The catch is that you must itemize your deductions on your federal tax return to claim any of this, so if you take the standard deduction, then SALT doesn't apply to you at all. California has the highest state income tax rates in the entire country, starting at 1% and climbing all the way up to 13.3%. Income over $1 million gets hit with an additional 1% mental health services tax, which pushes the top rate to 14.3% when you include everything. The state sales tax base rate sits at 7.25% before local jurisdictions add their piece, and property values throughout California rank among the highest in the nation. Even though the average property tax rate comes in at a relatively modest 0.71%, the actual dollar amounts add up fast because that percentage applies to expensive real estate. High property taxes plus high state income taxes means California residents, retirees included, often hand over tens of thousands of dollars in state and local taxes every year. Before 2018, you could deduct all of those taxes on your federal return, but the Tax Cuts and Jobs Act of 2017 imposed a $10,000 cap starting in 2018. A married couple in California paying $30,000 in combined state income tax and property tax suddenly found that $20,000 of their tax payments became non-deductible, which increased their federal tax bill by thousands of dollars overnight. The cap hit hardest in states like California, New York, and New Jersey. Middle-class and upper-middle-class families living in expensive areas saw federal tax increases even though the 2017 law lowered tax rates overall, and retirees felt the squeeze particularly hard. Required minimum distributions from retirement accounts created taxable income that California taxed at those high state rates, and the federal government taxed them again while limiting how much of the state tax they could deduct. The 2025 legislation quadruples the SALT deduction cap to $40,000 for married couples, with one major catch. Your adjusted gross income has to be $500,000 or less to get the full benefit, and above that threshold the cap phases down. Annual inflation adjustments get built in, so the $40,000 limit will tick up slightly each year to keep pace with rising costs. Walk through what this means in real dollars for a California senior couple. Their income comes from Social Security, required minimum distributions from IRAs, and maybe a pension. California doesn't tax Social Security, which is one of the few breaks the state gives retirees, but let's say their RMDs and pension income put them at $150,000 in adjusted gross income for the year. They pay California's state income tax on that income, which at California's rates could easily run $12,000 to $15,000, and they pay property taxes on their home. Even with Proposition 13 limiting increases to 2% annually for long-time homeowners, property taxes on a California home purchased decades ago for $100,000 but now worth $800,000 could run $8,000 to $10,000 annually. State income tax and property tax together put this couple at around $23,000 in total state and local taxes each year. Under the old $10,000 SALT cap, they could only deduct $10,000 on their federal return, leaving $13,000 that couldn't be deducted. At the 24% federal tax bracket, that $13,000 of non-deductible taxes cost them an extra $3,120 in federal taxes. With the new $40,000 cap, they can deduct the full $23,000, which saves them $3,120 compared to the old cap. The question every senior needs to answer is whether to itemize deductions or take the standard deduction, and this is where it gets complicated. For 2025, the standard deduction for a married couple where both spouses are age 65 or older sits at $34,700, which is the regular standard deduction of $31,500 plus an extra $3,200 for being over 65. The new tax bill temporarily adds a $6,000 senior bonus deduction available from 2025 through 2028, though that bonus phases out for couples earning above $150,000. Taking the standard deduction means you don't get to claim SALT at all. The SALT deduction cap increase only helps you if your total itemized deductions exceed your standard deduction, so you need to add up all your potential itemized deductions. State and local taxes under the new $40,000 cap go in first, then your mortgage interest if you still have a mortgage, then your charitable contributions, and finally your medical expenses that exceed 7.5% of your adjusted gross income. Our example couple paying $23,000 in state and local taxes would need at least $11,700 more in other itemized deductions to exceed the $34,700 standard deduction and make itemizing worthwhile. Donating $5,000 to charity and having $8,000 in deductible medical expenses gives them $36,000 in total itemized deductions, which exceeds the standard deduction by only $1,300. Itemizing saves them about $312 in federal taxes compared to taking the standard deduction, assuming the 24% bracket applies. The math shifts dramatically if their state and local taxes run much higher. A couple with the same income living in a pricier area of California might pay $20,000 in property taxes alone, plus $15,000 in state income tax, for a total of $35,000 in SALT. Even under the old cap, they could only deduct $10,000, but with the new $40,000 cap, they can deduct the full $35,000. Add $5,000 in charitable giving and $8,000 in medical expenses and their total itemized deductions reach $48,000, which exceeds the standard deduction by over $13,000 and saves them about $3,120 in federal taxes compared to the standard deduction. Not every California senior benefits from this change. Taking the standard deduction because your itemized deductions don't exceed it means the SALT cap increase doesn't help you at all. Most taxpayers take the standard deduction because it's simpler and often more valuable, and the Tax Policy Center estimated that after the 2017 tax law took effect, about 90% of taxpayers went with the standard deduction. Seniors who benefit most from the SALT cap increase are those with high property taxes and high state income taxes who were already close to itemizing or who were itemizing despite the old $10,000 cap. Seniors with adjusted gross income above $500,000 form another group that doesn't benefit. The $40,000 SALT cap phases down for higher earners and eventually disappears, so if your income falls in that range, you need to calculate your specific situation with a tax professional to understand how much of the cap applies. The SALT deduction cap increase is completely separate from the new $6,000 senior bonus deduction, which creates confusion. The senior bonus is an additional deduction available to everyone age 65 and older who earns under certain income limits, $75,000 for single filers and $150,000 for married couples. That bonus deduction gets claimed regardless of whether you itemize or take the standard deduction, and it's essentially a supplement that reduces your taxable income by $6,000, though it's temporary and only lasts from 2025 through 2028. The SALT deduction cap increase only helps if you itemize, and it's part of the overall calculation of whether itemizing makes sense for you. They work together, but they're different provisions with different eligibility rules. A senior couple earning $130,000 might get the full $6,000 bonus and also benefit from the SALT cap increase if they itemize, while a couple earning $200,000 wouldn't get the senior bonus because their income is too high but could still benefit from the SALT cap increase. Timing matters when thinking about this change. The new SALT cap applies to your 2025 tax return, which you'll file in early 2026, and it remains in effect through the 2029 tax year when you file returns in 2030. After that, the provision expires unless Congress extends it, and given that the Congressional Budget Office estimates the overall tax bill will add $4.1 trillion to the federal deficit over the next decade, future extensions are uncertain and will depend on the political composition of Congress and budget priorities at that time. Retirement planning for the next 5 years involves both opportunity and challenge. The opportunity is that you have more flexibility in managing your taxable income and your deductions, but the challenge is that you can't count on this provision lasting beyond 2029. Any long-term planning needs to account for the possibility that the cap returns to $10,000 or changes in some other way. Timing of income and deductions becomes a strategic consideration. Roth conversions, where you convert money from a traditional IRA to a Roth IRA and pay taxes on the converted amount, become less painful with the higher SALT deduction. The conversion increases your taxable income, which increases your California state income tax, and under the old $10,000 SALT cap, much of that state tax wasn't deductible on your federal return. With the $40,000 cap, more of that state tax becomes deductible, reducing the federal tax cost of the conversion. Bunching your deductions is another strategy worth considering. You deliberately concentrate your itemized deductions into 1 year and take the standard deduction in alternate years. Making 2 years' worth of charitable contributions in 1 year works well for this, or if possible, prepaying property taxes in December to accelerate the deduction into the current year. In the year you bunch deductions, your itemized deductions exceed the standard deduction and you benefit from itemizing, and in the next year you take the standard deduction. The higher SALT cap makes this strategy more sophisticated because it gives you more room to work with. A senior couple normally pays $22,000 in SALT each year, donates $4,000 to charity, and has $6,000 in medical expenses. That's $32,000 in itemized deductions, which falls short of their $34,700 standard deduction, so they're better off taking the standard deduction every year. Bunching changes the calculation. In year 1, they pay their normal state and local taxes of $22,000 but donate $8,000 to charity instead of $4,000, making their 2-year charitable commitment in 1 year. They also time an elective medical procedure and dental work to bunch $12,000 of medical expenses into year 1 instead of spreading it over 2 years. Year 1 now has $42,000 in itemized deductions, which exceeds the standard deduction by over $7,000. In year 2 they have only $22,000 in SALT, no charitable giving, and minimal medical expenses, so they take the $34,700 standard deduction that year. Over 2 years they've deducted a total of $76,700 instead of $69,400 if they'd taken the standard deduction both years, saving about $1,752 in federal taxes over the 2-year period at the 24% bracket. The SALT deduction cap increase doesn't help with your Medicare premiums, which is something many people misunderstand. Higher income retirees pay an income-related monthly adjustment amount, or IRMAA, which is a surcharge added to Medicare Part B and Part D premiums. For 2025, IRMAA kicks in at $106,000 of modified adjusted gross income for single filers and $212,000 for married couples. The SALT deduction doesn't reduce your modified adjusted gross income because it's a below-the-line deduction, meaning it comes after a GI is calculated. The higher SALT cap can reduce your federal income tax, but it doesn't help you avoid or reduce IRMAA. Understanding how different tax provisions interact is critical for retirement tax planning. Your required minimum distributions, which you must start taking at age 73 under current law, create taxable income that California taxes at high state rates, and the state tax you pay becomes part of your SALT deduction calculation. Higher RMDs mean higher state income tax, which makes the SALT deduction more valuable if you're itemizing, but higher RMDs also increase your adjusted gross income, which could push you closer to the $500,000 threshold where the SALT cap starts phasing down or increase your IRMAA surcharges. California's property tax rules under Proposition 13 add another layer. Passed way back in 1978, Proposition 13 limits property tax increases to 2% per year for existing owners based on the property's assessed value when purchased or last transferred. Longtime California homeowners often pay far less in property taxes than their neighbors who bought recently. Owning your home for decades means your property taxes might be quite modest relative to the home's current value, but moving recently or thinking about downsizing means your property taxes on a newly purchased home will be based on the full purchase price, potentially increasing your property tax bill dramatically and making the higher SALT deduction even more valuable. Proposition 19, passed in 2020 and effective in 2021, made changes to property tax rules that interact with retirement planning. Seniors aged 55 or older can now transfer their property tax base to a new home anywhere in California up to 3 times in their lifetime. Downsizing or relocating within the state lets you keep your low property tax base from your old home when you move, but buying a more expensive home means the difference in value gets added to your transferred tax base, potentially increasing your property taxes. The higher SALT deduction cap makes moving to a more expensive home slightly less costly from a federal tax perspective because more of the increased property taxes become deductible. Most seniors won't itemize deductions even with the higher SALT cap because the standard deduction, especially with the extra amounts for being over 65, is simply too large. For 2025, a single senior gets a standard deduction of $17,750 and a married couple both over 65 gets $34,700. Unless your itemized deductions significantly exceed those amounts, you're better off with the standard deduction, and that's perfectly fine because the standard deduction is designed to be simple and sufficient for most taxpayers. Running the calculation every year is what you need to do. Add up your potential itemized deductions including your state and local taxes up to the $40,000 cap, your mortgage interest, your charitable contributions, and your medical expenses over 7.5% of your AGI. Compare that total to your standard deduction and use whichever number is larger. Don't assume that because you took the standard deduction last year you should this year, because your situation changes. Major medical expenses this year, a large charitable contribution, or significantly increased required minimum distributions that pushed up your state income tax all change the calculation. Run the numbers every year. Tax software makes this easier since programs like TurboTax, H&R Block, and TaxAct automatically calculate both your itemized deductions and your standard deduction and use whichever is higher. Even with software, you need to have all your information organized though. Keep records of your property tax payments, your state income tax payments including estimated taxes, your charitable contribution receipts, and your medical expense records. Good record keeping can make the difference if you're close to the threshold where itemizing would benefit you. Political controversy around the SALT deduction has existed since the cap was first imposed in 2017. Supporters of the cap argue that the deduction primarily benefits higher-income households and that capping it helped pay for other tax cuts in the 2017 law. They point out that allowing unlimited SALT deductions means the federal government subsidizes high state and local taxes, which creates an incentive for states to tax more and spend more. Critics argue that the cap hits middle-class families in high-cost areas unfairly, that it amounts to double taxation since you're paying federal tax on money that went to state and local taxes, and that it creates geographic inequality because residents of low-tax states benefit less from any SALT deduction. The increase to $40,000 is a compromise. Residents of high-tax states get significant relief without completely removing the cap, but it's also expensive. The Congressional Budget Office estimates that the overall tax bill, including the SALT cap increase and all the other provisions, will add over $4 trillion to the federal deficit over 10 years. That's substantial, and it raises questions about the long-term sustainability of these tax cuts and whether future Congresses will be willing or able to extend them when they expire. The practical reality for California seniors is that the higher SALT cap is available for 5 years through 2029. Benefiting from itemizing means you should take advantage of it during this period. Use the additional deduction capacity to do strategic tax planning, consider Roth conversions when it makes sense, think about timing large deductions, and work with a financial advisor or tax professional who understands California taxes and federal retirement tax rules to optimize your situation. Don't build your entire retirement plan around the assumption that the $40,000 cap will last forever though. Plan for the possibility that it expires or gets reduced after 2029 and keep enough flexibility in your financial situation to adjust if the rules change. This is sound advice for any tax planning actually, because tax laws change frequently and what's true today may not be true in 5 or 10 years. Working with tax professionals matters when dealing with the interaction between California state taxes, federal taxes, required minimum distributions, Social Security taxation, Medicare IRMAA surcharges, and various deduction strategies. A qualified tax advisor who specializes in retirement planning can help you navigate these rules and find opportunities to reduce your overall tax burden. The cost of professional advice often pays for itself many times over in tax savings and peace of mind. The SALT deduction cap increase is part of a larger package of tax changes that affect seniors. The $6,000 senior bonus deduction can work alongside the SALT deduction if you qualify, and changes to required minimum distribution rules with the RMD age now at 73 affect the income side of the equation. The higher child tax credit doesn't affect most seniors, but other provisions in the bill like increased reporting thresholds for 1099 forms might reduce administrative hassles if you have side income or rental properties. Understanding how all these pieces fit together is part of comprehensive retirement tax planning. Your taxes in retirement aren't just about one deduction or one income source but about the interplay between multiple income streams, multiple deductions, state and federal rules, and strategies for timing and managing both income and deductions to minimize your total tax burden over time. California's high tax rates make this planning especially important. The state offers the significant benefit of not taxing Social Security, but it more than makes up for that by taxing all other retirement income at rates that can reach over 13%. Property taxes, even with Proposition 13 protections, continue throughout retirement, and the combination means that for many California seniors, state and local taxes represent one of the largest expenses in retirement, often rivaling or exceeding healthcare costs. The SALT deduction cap increase provides some relief by allowing you to deduct more of those state and local taxes on your federal return. It doesn't eliminate the underlying state tax burden, but it reduces the federal tax you pay on top of it. A couple paying $35,000 in combined state income tax and property tax being able to deduct the full amount instead of just $10,000 can save $3,000 to $4,000 a year in federal taxes at the 24% bracket. That's not trivial for retirees on fixed incomes. The key takeaways come down to this. The SALT deduction cap increased from $10,000 to $40,000 for the 2025 through 2029 tax years for taxpayers with adjusted gross income under $500,000. This change primarily benefits residents of high-tax states like California who itemize deductions. To benefit, your total itemized deductions must exceed your standard deduction, which for seniors includes extra amounts for being over 65. The higher cap works best for seniors with substantial property taxes and state income taxes. It doesn't help those who take the standard deduction, and it doesn't reduce Medicare IRMAA surcharges because it's a below-the-line deduction. The provision is temporary and expires after 2029 unless extended by future legislation. During the 5 years it's available, seniors can use it for strategic tax planning, including Roth conversions and deduction bunching strategies. The change is part of broader tax legislation that also includes the temporary $6,000 senior bonus deduction and other provisions. The interaction between multiple tax rules means that comprehensive planning is essential, and working with a qualified tax professional can help optimize your situation. California seniors wondering whether this affects them should start by gathering tax information and calculating potential itemized deductions under the new rules. Add up state and local taxes paid, including property taxes and state income taxes, add mortgage interest if you have a mortgage, add charitable contributions, and add medical expenses above 7.5% of adjusted gross income. Compare that total to your standard deduction. Itemizing saves you money if that total exceeds the standard deduction, which means you benefit from the SALT cap increase. The standard deduction being higher means you don't benefit from this particular change, though you might benefit from other provisions like the senior bonus deduction. California seniors with high property taxes and significant retirement income that's taxed by the state now have more flexibility and potentially lower federal taxes than they did under the $10,000 cap. The quadrupling of the cap to $40,000 makes itemizing more attractive and can save thousands of dollars per year for those who benefit. It's not automatic, it's not permanent, and it requires careful calculation to determine if it helps your specific situation. That's the story of the SALT deduction cap increase and how it affects California seniors. Tax planning in retirement is complicated, and this change adds another layer to consider, but it also creates opportunities for those who can take advantage of it. The next 5 years offer a window to reduce your federal tax burden if you're paying high California taxes, and understanding how to use that window effectively can make a real difference in your retirement finances.